Chapter 8. Understanding Your Investment Choices. In this chapter, playing it safe, bonds, growing your wealth, stocks, real estate, and small business, eyeballing oddball investments, precious metals, annuities, crypto, and collectibles. Avoid gambling and get-rich-quick schemes. Making wise investments need not be complicated. However, many investors get bogged down in the morass of the thousands of investment choices out there and the often conflicting perspectives on how to invest. This chapter describes the investment choices you can make and helps you match the types of investments to your tax situation. Slow and steady investment, bonds. Everyone should have money in stable, safe investment vehicles, including money that you've earmarked for your near-term expenses, both expected and unexpected. Likewise, if you're saving money for a home purchase within the next few years, you certainly don't want to risk that money on the roller coaster of the stock market. The investment option of bonds is appropriate for money you don't want to put at great risk. When you invest in a bond, you effectively lend your money to an organization. When a bond is issued, it includes a specified maturity date at which time the principal will be repaid. Bonds are also issued at a particular interest rate, or what's known as a coupon. This rate is fixed on most bonds. So, for example, if you buy a 5-year, 6% bond issued by Home Depot, you're lending your money to Home Depot for 5 years at an interest rate of 6% per year. Bond interest is usually paid in 2 equal semi-annual installments. The value of a bond generally moves opposite of the directional change in interest rates. For example, if you're holding a bond issued at 6% and rates on similar bonds increase to 8%, your 6% bond will decrease in value. Why would anyone want to buy your bond at the price you paid if it yields just 6% and 8% can be obtained elsewhere? Some bonds are tied to variable interest rates. For example, you can buy bonds that are adjustable rate mortgages on which the interest rate can fluctuate. As an investor, you're actually lending your money to a mortgage borrower. Indirectly, you're the banker making a loan to someone buying a home. Bonds differ from one another in the following major ways. The type of institution to which you're lending your money. With municipal bonds, you lend your money to the state or local government or agency. With treasuries, you lend your money to the federal government. With GNMAs, Ginnie Maes, you lend your money to a mortgage holder, and the federal government backs the bond, and with corporate bonds, you lend your money to a corporation. The credit quality of the borrower to whom you lend your money. Credit quality refers to the probability that the borrower will pay you the interest and return your principal as agreed. The length of maturity of the bond. Short-term bonds mature within a few years, intermediate bonds within 3 to 10 years, and long-term bonds within 10 to 30 years. Longer-term bonds generally pay higher yields, but fluctuate more with changes in interest rates. Technical stuff. Bonds are rated by major credit rating agencies for their safety, usually on a scale where AAA is the highest possible rating. For example, high-grade corporate bonds, AAA or AA, are considered the safest, that is most likely to pay you back. Next in safety are general bonds, A or BBB, which are still safe, but just a little less so. Junk bonds rated BB or B are actually not all that junky. They're just lower in quality and have a slight 1 or 2% probability of default over long periods of time. Junk bonds with even lower ratings, such as C or lower, carry higher default rates. Some bonds are callable, which means that the bond's issuer can decide to pay you back earlier than the previously agreed-upon date. This event usually occurs when interest rates fall and the lender wants to issue new, lower interest rate bonds to replace the higher rate outstanding bonds. To compensate you for early repayment, the lender typically gives you a small premium over what the bond is currently valued at. Building wealth with ownership vehicles. The 3 best legal ways to build wealth are to invest in stocks, both domestic and international, real estate, and small business. I found this to be true from observing many clients and other investors, and from my own personal experiences. Check out the following sections for more details about these 3 options. Warning: The risk with ownership investments is the short-term fluctuations in their value. During the last century, stocks declined on average by more than 10% once every 5 years. Drops in stock prices of more than 20% occurred on average once every 10 years. Real estate prices suffer similar periodic setbacks. Therefore, in order to earn those generous long-term returns from ownership investments like stocks and real estate, you must be willing to tolerate volatility. You absolutely should not put all your money in the stock or real estate market. Investing your emergency money, or money you expect to use within the next 5 years, in such volatile investments is not a good idea. The shorter the time period that you have for holding your money in an investment, the less likely growth-oriented investments like stocks are to beat out lending-type investments like bonds. Remember, diversification is one of the most powerful investment concepts. It refers to saving your eggs, or investments, in different baskets. Diversification requires you to place your money in different investments with returns that are not completely correlated, which is a fancy way of saying that when some of your investments are down in value, odds are that others are up in value. To learn more about diversification and asset allocation strategies, see my book, Investing for Dummies, Wiley. Selecting stocks. Stocks, which represent shares of ownership in a company, are the most common ownership investment vehicle. When companies go public, they issue shares of stock that people like you and me can purchase on the major stock exchanges, such as the New York Stock Exchange and NASDAQ, National Association of Securities Dealers Automated Quotations. As the economy grows and companies grow with it, earning greater profits, stock prices and dividend payouts on those stocks generally follow suit. Stock prices and dividends don't move in lockstep with earnings, but over the years, the relationship is pretty close. In fact, the price-earnings ratio, which measures the value of stock prices relative to or divided by company earnings of U.S. stocks, has averaged approximately 15, although it has tended to be higher during periods of low inflation and interest rates. A price-earnings ratio of 15 simply means that stock prices per share, on average, are selling at about 15 times those companies' earnings per share. Companies that issue stock, called publicly held companies, include automobile manufacturers, computer software producers, fast food and other restaurant chains, hotels, publishers, supermarkets, technology companies, wineries, and everything in between. You can also invest overseas. See the Investing Internationally in Stocks section. By contrast, some companies are privately held, which means that they've elected to have senior management and a small number of affluent investors own their stock. Privately held companies' stocks do not trade on a stock exchange, so folks like you and me can't buy stock in such firms. Technical stuff. Companies differ in what industry or line of business they're in and also in size. In the financial press, you often hear companies referred to by their market capitalization, which is the value of their outstanding stock, the number of total shares multiplied by the market price per share. When describing the sizes of companies, Wall Street has done away with such practical adjectives as big and small and replaced them with expressions like large cap and small cap, where cap is shorthand for market capitalization. Such is the language of financial geekiness. Remember, investing in the stock market involves occasional setbacks and difficult moments, just like raising children or going mountain climbing. But the overall journey is almost certainly worth the effort. Over the past 2 centuries, the U.S. stock market has produced an annual average rate of return of about 9%. However, the market, as measured by the Dow Jones Industrial Average, fell more than 20% during 16 different periods in the 20th century. On average, these periods of decline lasted less than 2 years. So if you can withstand a temporary setback over a few years, the stock market is a proven place to invest for long-term growth. You can invest in stocks by making your own selection of individual stocks or by letting mutual or exchange-traded funds do it for you. Discovering the relative advantages of mutual funds and exchange-traded funds, ETFs. Tip: efficiently managed mutual funds offer investors low-cost access to high-quality money managers. Mutual funds span the spectrum of risk and potential returns, from non-fluctuating money market funds, which are similar to savings accounts, to bond funds, which generally pay higher yields than money market funds but fluctuate with changes in interest rates, to stock funds, which offer the greatest potential for appreciation but also the greatest short-term volatility. Investing in individual securities should be done only by those who really enjoy doing it and are aware of and willing to accept the risks in doing so. Mutual funds and exchange-traded funds, see the next section, if properly selected, are a low-cost, quality way to hire professional money managers. Over the long haul, you're highly unlikely to beat full-time professional managers who are investing in securities of the same type and at the same risk level. Chapter 9 is devoted to mutual funds and exchange-traded funds. Understanding exchange-traded funds, hedge funds, and managed accounts. Mutual funds aren't the only game in town when it comes to hiring a professional money manager. 3 additional options you may hear about include exchange-traded funds, ETFs. These funds are the most similar to mutual funds, except that they trade on a major stock exchange and thus can be bought and sold during the trading day. The best ETFs have low fees and, like an index fund, see Chapter 9, invest to track the performance of a particular stock market index. Hedge funds. These privately managed funds are for wealthier investors and are generally riskier, some even go bankrupt, than a typical mutual fund. The fees can be steep, typically 15 to 20% of the hedge fund's annual returns, as well as an annual management fee of 1% or so. They're also generally illiquid. There are usually lock-up periods, and it can still be difficult to get your money back out later when needed. I generally don't recommend them. Managed accounts. The major brokerage firms, which employ brokers on commission, offer access to private money managers. In reality, this option isn't really different from getting access to fund managers via mutual funds, but you'll generally pay a much higher fee, which reduces this option's attractiveness. Investing in individual stocks. My experience is that plenty of people choose to invest in individual stocks because they think that they're smarter or luckier than the rest. I don't know you personally, but it's safe to say that in the long run, your investment choices are highly unlikely to outperform those of the best full-time investment professionals and index funds. Warning. Of course, you may find some people with a vested interest who try to convince you that picking your own stocks and managing your own portfolio of stocks is easy and more profitable than investing in, say, a mutual fund or an ETF. Researching individual stocks can be more than a full-time job, and if you choose to take this path, remember that you'll be competing against the professionals who do so on a full-time basis. Tip: if you derive pleasure from picking and following your own stocks, or you want an independent opinion of some stocks you currently own, useful research reports are available from Value Line. Call 800-825-8354 or visit valueline.com. I also recommend that you limit your individual stock holdings to no more than 20% of your overall investments. Investing internationally in stocks. Not only can you invest in company stocks that trade on the U.S. stock exchanges, but you can also invest in stocks around the world. If you're in the United States, you may ask, why would you want to invest in international stocks? Here are 2 solid reasons. Many investing opportunities exist overseas. If you look at the total value of all stocks outstanding worldwide, the value of foreign stocks typically equals or exceeds the value of U.S. stocks. When you confine your investing to U.S. securities, you miss a world of opportunities, not only because of business growth available in other countries, but also because you get the opportunity to diversify your portfolio even further. International securities markets don't move in tandem with U.S. markets. During various U.S. stock market drops, some international stock markets drop less, whereas others may sometimes rise in value. So where are the major investing opportunities outside the United States? International investing managers generally look at opportunities in 3 major geographic regions. Latin America includes countries such as Argentina, Brazil, Chile, Colombia, Costa Rica, Mexico, Panama, and Peru. Europe Includes countries such as Belgium, Denmark, France, Germany, Ireland, Italy, Netherlands, Norway, Spain, Sweden, Switzerland, and the United Kingdom. Asia-Pacific includes countries such as Australia, China, India, Japan, Hong Kong, New Zealand, Singapore, South Korea, Taiwan, Thailand, and Vietnam. Companies in Canada are generally a small investment portion held by many international and global stock funds. Canadian holdings may be listed separately or as a part of North America holdings. Another way in which foreign stocks are categorized is between developed markets and emerging markets. Developed markets are characterized by more mature, stable, and secure economies with relatively high standards of living. Examples include countries such as Australia, Canada, France, Germany, Japan, Switzerland, and the United Kingdom. Emerging markets tend to be more volatile and typically higher growth economies that are in their early economic stages. Examples include countries such as Brazil, China, Chile, India, Indonesia, Malaysia, Mexico, South Africa, and Thailand. Generating wealth with real estate. Over the generations, real estate owners and investors have enjoyed rates of return comparable to those produced by the stock market, thus making real estate another time-tested method for building wealth. However, like stocks, real estate goes through good and bad performance periods. Most people who make money investing in real estate do so because they invest over many years and do their homework when they buy to ensure that they purchase good property in solid locations at an attractive/fair price. Part 5 covers finding tax breaks for investing in real estate. Tip: buying your own home is the best place to start investing in real estate. The equity, the difference between the market value of the home and the loan owed on it in your home that builds over the years, can become a significant part of your net worth. Among other things, you can tap this equity to help finance other important personal goals, such as retirement, higher education costs, and starting or buying a business. Moreover, throughout your adult life, owning a home should be less expensive than renting a comparable home. Investing in small business. Tip: small business is the leading investment through which folks have built the greatest wealth. You can invest in small business by starting one yourself, and thus finding yourself the best boss you've probably ever had, buying an existing business, or investing in someone else's small business. Part 4 covers the tax reduction and other details for each of these options. Off the beaten path. Investment odds and ends. The investments that I discuss in this section sometimes belong on their own planet because they're not an ownership or lending vehicle. Here are the basics on these other common but odd investments. Precious metals. Gold and silver have been used by many civilizations as currency or a medium of exchange. One advantage of precious metals as a currency is that they can't be debased by the government. With paper currency, such as U.S. dollars, the government can simply print more. This process can lead to the devaluation of a currency and inflation. Holdings of gold and silver can provide a so-called hedge against inflation. In the late 1970s and early 1980s, inflation rose dramatically in the United States. This largely unexpected rise in inflation depressed stocks and bonds. Gold and silver, however, rose tremendously in value. In fact, more than 500%, even after adjusting for inflation, from 1972 to 1980. Such periods are unusual. Precious metals produced decent returns in the 2000s, but after peaking in 2011, precious metals prices fell steeply before recovering in the 2020s. Over many decades, precious metals tend to be lousy investments. Their rate of return tends to keep up with the rate of inflation, but not surpass it. Tip: when you want to invest in precious metals as an inflation hedge, your best option is to do so through mutual funds or exchange-traded funds. See Chapter 9. Don't purchase precious metals futures. They're not investments. They're short-term gambles on which way gold or silver prices may head over a short period of time. I also recommend staying away from firms and shops that sell coins and bullion, not the soup but bars of gold or silver. Even if you can find a legitimate firm, not an easy task, the cost of storing and insuring gold and silver is quite costly. You won't get good value for your money. Markups can be substantial. Bitcoin, Ethereum, and other cryptocurrencies. Perhaps you have heard of Bitcoin, the online currency. I find that far more young adults know about it than older folks do, which makes sense because it's a digital currency used for internet transactions. Increasingly, Bitcoin has been in the news more and more as its price climbs to ever-dizzying higher heights. In December 2017, the price of a Bitcoin neared the $20,000 mark. It then plunged to less than $4,000 late in 2018. The roller coaster continued, with Bitcoin surging again and zooming past $68,000 in late 2021. By late 2022, it sank below $16,000, and as of the writing of this book in late 2023, it's at about $26,000. So what exactly is Bitcoin? For starters, it's not actually a coin. Calling it a coin is a marketing gimmick to make it sound like a real currency. Bitcoin and other similar cryptocurrencies only exist in the online world. Bitcoin's creators have limited the number of Bitcoins that can be mined and put into online circulation to about 21 million. More on mining later in this section. As its promoters have talked up its usefulness and dizzying rise, many people who have Bitcoins continue to hold on to them in the hopes that the price will keep rising. Like shares of stock in the next Amazon.com or Apple, its owners and promoters are hoping and expecting for further steep price increases. People don't hoard real currencies with similar pie-in-the-sky hopes for large investment returns. Ethereum is the second most popular cryptocurrency as people discover that it allows for incorporating smart contracts, which are computer-based and enforced contracts that delineate specific conditions that must be met in order for the transaction to be completed. Like Bitcoin, Ethereum has had wild boom-bust price swings. Warning: Bitcoin looks attractive, but it comes with risks and problems. Here are some major issues. No repercussions or recourse. Online Bitcoin transactions can be done anonymously, and they can't be contested, disputed, or reversed. If you buy something using Bitcoin and have a problem with the item you bought, that's too bad. You have no recourse, unlike, for example, with a purchase made on your credit card. The clandestine nature of cryptocurrencies makes them attractive to folks trying to hide money or engage in illegal activities, for instance, criminals, drug dealers, and so on. No inherent value. Contrast that with gold. Not only has gold had a long history of being used as a medium of exchange, currency, gold has commercial and industrial uses. Furthermore, gold costs real money to mine out of the ground, which provides a floor of support under the price of gold at about $1,300 per ounce, not far below the recent price of gold at about $2,000 per ounce. Bitcoin does have a made-up mining process whereby you need special computer equipment and end up using a bunch of electricity to solve complex math problems. Not unlimited. The supply of Bitcoin is currently artificially limited, and Bitcoin is hardly unique. It's one of hundreds of cryptocurrencies. So, if another cryptocurrency or two or three is easier to use online and perceived as attractive, in part because it's far less expensive, Bitcoin will eventually tumble in value. Not universally accepted. Even though Bitcoin has been the most popular cryptocurrency in recent years, few merchants actually accept it. And to add insult to injury, Bitcoin users get whacked with unfavorable conversion rates, which add greatly to the effective price of items bought with Bitcoin. Problematic exchanges. There are many safe and reputable brokerage firms protected by regulatory oversight and insurance through which you can buy stocks and other securities. That is not the case with buying and selling cryptocurrency. Numerous such crypto brokers have blown up, FTX being the largest and most famous, due to incompetence and in some cases outright fraud. There's a lack of regulatory oversight, and many such brokers are located outside the United States. The U.S. Securities and Exchange Commission is playing catch-up and beginning to get its arms around the industry's myriad problems. In 2024, about $1.8 trillion was tied up in these cryptocurrencies, according to CoinMarketCap.com, which now tracks more than 26,000 cryptocurrencies. Over the preceding years, Bitcoin's market share has dropped from nearly 90% to about 52%. CoinMarketCap.com tracks the 100 largest cryptocurrencies as measured by their market capitalizations. Number 100 on the list recently had a market cap of about $650 million. I can't tell you what will happen to Bitcoin's price next month, next year, or next decade, but I can tell you that it has virtually no inherent value as a digital currency, so those paying thousands of dollars for a Bitcoin will eventually be extremely disappointed. With more than 26,000 of these cryptocurrencies, the field keeps growing as creators hope to get in on the ground floor of the next cryptocurrency, which they hope will soar in value. A recent Wall Street Journal investigation found hundreds of technology firms raising money in the fevered market for cryptocurrencies are using deceptive or even fraudulent tactics to lure investors. The Wall Street Journal has found 271 with red flags that include plagiarized investor documents, promises of guaranteed returns, and missing or fake executive teams. Annuities. Annuities are a peculiar type of insurance and investment product. They're a sort of savings-type account with slightly higher yields, and they're backed by insurance companies. Fixed annuities pay a preset interest rate determined by the insurance company. This rate is typically set 1 year ahead at a time. Variable annuities return varies over time, depending on the returns provided by the investment that's chosen within the annuity offerings. As with other types of retirement accounts covered in Chapter 4, money placed in an annuity compounds without taxation until it's withdrawn. However, unlike most other types of retirement accounts, such as 401ks, SEP IRAs, and 403bs, you don't receive upfront tax breaks on contributions you make to an annuity. Ongoing investment expenses also tend to be much higher than in retirement plan accounts. Therefore, consider an annuity generally only after you fully fund tax-deductible retirement accounts. There's one other possible personal use for annuities. Those nearing or in retirement with limited resources can insure against the risk of outliving their assets by buying an annuity and annuitizing it, again at a cost, so proceed carefully. Collectibles, including NFTs. The collectibles category is a catch-all for antiques, art, autographs, baseball cards, clocks, coins, comic books, diamonds, dolls, gems, photographs, rare books, rugs, stamps, vintage wine, and writing utensils. In other words, any material object that through some kind of human manipulation has become more valuable to certain humans. Coinciding with the rise of cryptocurrencies, there are now NFTs, which stands for non-fungible tokens, that some have called digital collectibles. Warning: notwithstanding the few people who discover on Antiques Roadshow that they own an antique of significant value, collectibles are generally lousy investment vehicles. Dealer markups are enormous, maintenance and protection costs are draining, research is time-consuming, and people's tastes are quite fickle. All this for returns that, after you factor in the huge markups, rarely keep up with inflation. Furthermore, long-term investment gains of more than 1 year you do earn on collectibles are currently taxed at your ordinary federal income tax rate with a cap of 28%, which is higher than the long-term capital gains tax rate on stocks, real estate, and small business, 20%, held for a year or more. Tip: buy collectibles for your love of the object, not for financial gain. Treat collecting as a hobby rather than as an investment. When buying a collectible, try to avoid the big markups by cutting out the middlemen. Buy directly from the artist or producer, if you can. With regards to NFTs, I would be very, very, very careful and steer clear until this market, which is in its infancy and largely untested, better proves itself. Shunning gambling and get-rich-quick vehicles. Although investing is often risky, it's not gambling. Gambling is putting your money into schemes that are sure to lose you money over time. That's not to say that everyone loses or that you lose every time you gamble. However, the deck is stacked against you. The house wins most of the time. Warning: casinos and lotteries are set up to pay out 50 to 60 cents on the dollar. The rest goes to profits and covering those businesses' operating costs. Sure, you may win a bet or two, but in the long run, you're also guaranteed to lose about 40 to 50% of what you bet. Would you put your money in an investment where your expected return over the long term was negative 40%? Forsaking futures, options, and other derivatives. Futures, options, and commodity futures are derivatives, or financial investments whose value is derived from the performance of another security, such as a stock or bond. Suppose you're solicited by the firm Fleesham, Cheatham, and Leatham to buy heating oil futures because of conflicts in the Middle East and the upcoming rise in heating oil usage due to the cold weather months. You're impressed by the smooth-talking vice president. Their logic makes sense, and they spend a lot of time with little old you, so you send them $10,000. Buying futures isn't much different from blowing $10,000 at the craps tables in Las Vegas. Futures prices depend on short-term, highly volatile price movements. As with gambling, you occasionally win when the market moves the right way at the right time, but in the long run, you're going to lose. In fact, you can lose it all. Options are as risky as futures. With options, you're betting on the short-term movements of a specific security, which is gambling, not investing. This was fashionable to do among some people who used government-distributed COVID-19 stimulus checks to try to hit it big. Honest brokers who help their clients invest in stocks, bonds, and mutual funds tell them the truth about commodities, futures, and options. A former broker I know who worked for various major brokerage firms for 12 years told me, "I had just one client who made money in options, futures, or commodities, but the only reason he came out ahead was because he was forced to pull money out to close on a home purchase just when he happened to be ahead. The commissions were great for me, but there's no way a customer will make money in them." Remember these words if you're tempted to gamble with futures, options, and the like. Futures and options are not always used for speculation and gambling. Some sophisticated professional investors use them to hedge or actually reduce the risk of their broad investment holdings. When futures and options are used in this fashion, things don't often work out the way that the pros hoped. You, the individual investor, should steer clear of futures and options. Ditching day trading. Warning: day trading, which is the rapid buying and selling of securities online, is an equally foolish vehicle for individual investors. This is speculation and gambling, not investing. And even if you're using a broker who offers free trading, every time you buy and sell, you're effectively paying a fee given the inevitable spread between the buy and sell price for a given security. Frequent trading also increases your tax bill, as profits realized over short time periods are taxed at your highest possible tax rate. You can certainly make some profits when day trading. However, over an extended period of time, you'll inevitably underperform the broad market averages. In those rare instances where you may do a little better than the market averages, the profits are rarely worth the time and personal sacrifices that you, your family, and your friendships endure. Sidestepping get-rich-quick schemes. Remember, if it sounds too good to be true, it probably is. In today's high-tech world, people are bombarded in all directions: mailers, social media ads, radio and podcast commercials, and on ways to make money fast. I'm here to tell you that getting rich quick is more of a pipe dream than an investment strategy. Investing for the long term is the way to grow your money. The best wealth-building investments historically have returned an average of about 8 to 9% per year. You should keep that number in mind as you evaluate seemingly attractive alternatives with the belief that you will double or triple your investment in a year or less. That's what lured so many inexperienced and naive investors into cryptocurrencies in recent years. Websites and social media recounted tales of folks becoming rich over short time periods after buying into a particular cryptocurrency like Bitcoin and Ethereum that zoomed skyward. New cryptocurrencies sprung up like weeds during a hot summer spell, and soon there were more than 26,000 of them. Needless to say, nearly all of these ended up being poor investments. As with past get-rich-quick schemes, investors kept buying into new offerings in the hopes of striking it rich. Chapter 9. Investing in Funds. In this chapter, grasping the merits of mutual funds and exchange-traded funds, ETFs, checking out the different types of funds, choosing the best funds. When you invest in a mutual fund or its close sibling, an exchange-traded fund, ETF, that trades on a stock exchange, an investment company pools your money with the money of many other individuals and invests it in stocks, bonds, and other securities. Think of it as a big investment club without the meetings. When you invest through a typical fund, several hundred million to billions of dollars are typically invested along with your money. If you're thinking of joining the club, read on to discover the benefits of investing in leading mutual funds and ETFs and the types of funds available. Understanding the benefits of mutual funds and exchange-traded funds. Mutual funds and exchange-traded funds, ETFs, rank right up there with microwave ovens, sticky notes, and cell phones as one of the best inventions. To understand their success is to grasp how and why these funds can work for you. Here are the benefits you receive when you invest in the best mutual funds and ETFs. Professional management. Mutual funds and ETFs are managed by a portfolio manager and research team whose full-time jobs are to screen the universe of investments for those that best meet the fund's stated objectives. These professionals call and visit companies, analyze companies' financial statements, and speak with companies' suppliers and customers. In short, the team does more research and analysis than you could ever hope to do in your free time. Fund managers are typically graduates of the top business and finance schools in the country, where they learn the principles of portfolio management and securities valuation and selection. The best fund managers typically have a decade or more of experience in analyzing and selecting investments, and many measure their experience in decades rather than years. Low fees. The most efficiently managed stock mutual funds and ETFs cost much less than 1% per year in fees. Bond and money market funds cost even less. And when you buy a no-load fund, you avoid paying sales commissions, known as loads, on your transactions. I discuss these types of funds throughout this chapter. You can buy an ETF for a low transaction fee through the best online brokers. Diversification. Fund investing enables you to achieve a level of diversification that's difficult to reach without tens of thousands of dollars and a lot of time to invest. If you go it alone, you should invest money in at least 15 to 20 different securities in different industries to ensure that your portfolio can withstand a downturn in one or more of the investments. Proper diversification allows a fund to receive the highest possible return at the lowest possible risk given its objectives. The most unfortunate investors during major stock market downswings have been individuals who had all their money riding on only a few stocks that plunged in price by 90% or more. Low cost of entry. Most mutual funds have low minimum investment requirements, especially for retirement account investors. ETFs essentially have no minimum, although you don't want to do transactions involving small amounts if your brokerage firm charges a fee, because that brokerage fee takes up a larger percentage of your investment amount. Even if you have a lot of money to invest, consider funds for the low-cost, high-quality money management services they provide. Audited performance records and expenses. In their prospectuses, all funds are required to disclose historical data on returns, operating expenses, and other fees. The U.S. Securities and Exchange Commission, SEC, and accounting firms check these disclosures for accuracy. Also, several firms, such as Morningstar and Value Line, report hundreds of fund statistics, allowing comparisons of performance, risk, and many other factors. Flexibility in risk level. Among the different funds, you can choose a level of risk that you're comfortable with and that meets your personal and financial goals. If you want your money to grow over a long period of time, you may want to select funds that invest more heavily in stocks. If you need current income and don't want investments that fluctuate in value as widely as stocks, you may choose more conservative bond funds. If you want to be sure that your invested principal doesn't drop in value, perhaps because you may need your money in the short term, you can select a money market fund. Exploring various fund types. In this chapter, I discuss the major types of funds: money market, bond, and stock funds. When fund companies develop and market funds, the names they give their funds aren't always completely accurate or comprehensive. For example, a stock fund may not be totally invested in stocks. 20% of it may be invested in bonds. Don't assume that a fund invests exclusively in U.S. companies either. It may invest in international firms as well. Note: if you haven't yet read Chapters 7 and 8, which provide an overview of investment concepts and vehicles, doing so can enhance your understanding of the rest of this chapter. Money market funds. Money market funds are generally considered the safest type of mutual funds, although not insured or guaranteed, for people concerned about losing their invested dollars. As with bank savings accounts, the value of your original investment does not fluctuate. These funds are closely regulated by the SEC. Trillions of dollars of individuals' and institutions' money are invested in money market funds. General-purpose money market funds invest in safe, short-term bank certificates of deposit, U.S. Treasuries, and corporate commercial paper, short-term debt, which is issued by the largest and most credit-worthy companies. Since their origination in the early 1970s, money market funds have been extremely safe. The risk difference versus a bank account is nil. Only twice have funds broken the buck, one by 6%, the other by 3%, and both funds were used only by institutional investors. Hundreds of trillions of dollars have flowed into and out of money funds over the decades without any retail investors losing principal. Money market fund investments can exist only in the most creditworthy securities and must have an average maturity of less than 120 days. In the unlikely event that an investment in a money market fund's portfolio goes sour, the mutual fund company that stands behind the money market fund will almost certainly cover the loss. Tip: if the lack of insurance on money market funds still spooks you, select a money market fund that invests exclusively in U.S. government securities, which are virtually risk-free because they're backed by the full strength and credit of the federal government, as is the FDIC insurance system. These types of accounts typically pay slightly less interest, although the interest is free of state income tax. Bond funds. Bonds are IOUs. When you buy a newly issued bond, you typically lend your money to a corporation or government agency. A bond fund is nothing more than a large group of bonds. Bond funds typically invest in bonds of similar maturity, the number of years that elapse before the borrower must pay back the money you lend. The names of bond funds include a word or two that provides clues about the average length of maturity of their bonds. For example, a short-term bond fund typically concentrates its investments in bonds maturing in the next 2 to 3 years. An intermediate-term fund generally holds bonds that come due within 3 to 10 years. The bonds in a long-term fund usually mature in more than 10 years. In contrast to an individual bond that you buy and hold until it matures, a bond fund is always replacing bonds in its portfolio to maintain its average maturity objective. Therefore, if you know that you absolutely positively must have a certain principal amount back on a particular date, individual bonds may be more appropriate than a bond fund. Like money market funds, bond funds can invest in tax-free bonds, which are appropriate for investing money you hold outside retirement accounts if you're in a reasonably high tax bracket. Tip: Bond funds are useful when you want to live off interest income, or you don't want to put all your money in riskier investments such as stocks and real estate, perhaps because you plan to use the money soon. Also, making small, incremental investments in a bond fund is easier, as opposed to the cost of buying a single individual bond, which can be many thousands of dollars. Bonds, especially municipal bonds, which are bonds issued by local or state government, are among the most inefficient parts of the U.S. securities markets. Individual investors can't easily determine the bond's true value and pay steep markups or markdowns, all of which a larger institutional trader, like a mutual fund, can more easily avoid. Stock funds. Stock funds, as their name implies, invest in stocks. These funds are often referred to as equity funds. Equity, not to be confused with equity in real estate, is another word for stocks. Stock funds are often categorized by the type of stocks they primarily invest in. Stock types are first defined by size of company, small, medium, or large. The total market value, capitalization, of a company's outstanding stock determines its size. Small company stocks, for example, are usually defined as companies with total market capitalization of less than $2 billion. Mid-cap stocks are defined as having a market capitalization of between $2 and $10 billion, and large-cap stocks are those with market caps over $10 billion. Stocks are further categorized as growth or value stocks. Growth stocks represent companies that are experiencing rapidly expanding revenues and profits and typically have high stock prices relative to their current earnings or asset book values. These companies tend to reinvest most of their earnings in their infrastructure to fuel future expansion. Thus, growth stocks typically pay low dividends. See the later dividend section for more information. Value stocks are at the other end of the spectrum. Value stock investors look for good buys. They want to invest in stocks that are cheaply priced in relation to the profits per share and book value, assets less liabilities, of the company. Value stocks are usually less volatile than growth stocks. These categories are combined in various ways to describe how a mutual fund invests its money. One fund may focus on large company growth stocks, while another fund may limit itself to small company value stocks. Funds are further classified by the geographical focus of their investments: U.S., international, worldwide, and so on. See the section U.S., International, and Global Funds. Mixing bonds and stocks. Balanced funds. Balanced funds invest in a mixture of different types of securities. Most commonly, they invest in bonds and stocks. These funds are usually less risky and volatile than funds that invest exclusively in stocks. In an economic downturn, bonds usually hold up in value better than stocks do. However, during good economic times, when the stock market is booming, the bond portions of these funds tend to drag down their performance a bit. Balanced mutual funds generally try to maintain a fairly constant percentage of investments in stocks and bonds. A similar class of funds, known as asset allocation funds, tends to adjust the mix of different investments according to the portfolio manager's expectations of the market. Of course, exceptions do exist. Some balanced funds adjust their allocations, whereas some asset allocation funds maintain a relatively fixed mix. Remember, most funds that shift money around instead of staying put in good investments rarely beat the market averages over a number of years. There are also now increasing numbers of target date or retirement date funds, which tend to decrease their risk and stock allocation over time. Such funds appeal to investors who are approaching a particular future goal, such as retirement or a child's college education, and want their fund to automatically adjust as that date approaches. Tip: Balanced funds are a way to make fund investing simple. They give you extensive diversification across a variety of investing options. They also make it easier for stock-skittish investors to invest in stocks while avoiding the high volatility of pure stock funds. U.S., international, and global funds. Unless they have words like international, global, worldwide, or world in their names, Most American-issued funds focus their investments in the United States. But even funds without one of these terms attached may invest some of its money internationally. Tip: the only way to know for sure where a fund is currently invested or where the fund may invest in the future is to investigate. A fund's annual report, which can be found on the fund company's website, details where the fund is investing. The prospectus will also detail where the fund can be invested. You can also call the toll-free number of the fund company you're interested in and ask. When a fund has the term international or foreign in its name, it typically means that the fund invests anywhere in the world except the United States. The term worldwide or global generally implies that a fund invests everywhere in the world, including the United States. Funds of funds. An increasing number of fund providers are responding to overwhelmed investors by offering a simplified way to construct a portfolio, a fund that diversifies across numerous other funds, or a fund of funds. When a fund of funds is done right, it helps focus fund investors on the important big-picture issue of asset allocation, how much of your investment money you put into bonds versus stocks. Although the best funds of funds appear to deliver a high-quality, diversified portfolio of funds in one fell swoop, funds of funds are not all created equal, and few are worthy of your investment dollars. The fund of funds idea isn't new. In fact, the concept has been around for many years. High fees gave the earlier funds of funds, run in the 1950s by the late Bernie Kornfeld, a bad name. Kornfeld established a fund of funds outside the United States and tacked on many layers of fees. Although the funds were profitable for his enterprise, duped investors suffered a continual drain of high fees. The Kornfeld episode is an important reason why the SEC has been careful in approving new funds of funds. The newer funds of funds developed by the larger fund companies are investor-friendly and ones that I recommend. Vanguard's Life Strategy and Target Retirement, Fidelity's Freedom, Schwab Target Date, and T. Rowe Price's Spectrum funds of funds add no extra fees for packaging together the individual funds. Long-term performance of many of these is solid. Annual operating fees on the underlying funds at Vanguard are around 0.1%. Index funds. Index funds are funds that can be, and are for the most part, managed by a formulaic approach. An index fund's assets are invested to replicate an existing market index, such as Standard & Poor's 500, an index of 500 large U.S. company stocks. Some exchange-traded funds are index funds, with the added twist that they trade on a major stock exchange. Over long periods, 10 years or more, index funds outperform about 3/4 of their peers. How is that possible? How can mindlessly mimicking the holdings of a given index beat an intelligent, creative, MBA-endowed portfolio manager with a crack team of research analysts scouring the market for the best securities? The answer is largely cost. You can run an index fund with a much smaller management team and without spending gobs of money on research. An index fund doesn't need a team of research analysts. In contrast to passively managed index funds, most active fund managers can't overcome the handicap of high operating expenses that pull down their fund's rates of return. As I discuss later in this chapter, operating expenses include all the fees and profit that a mutual fund extracts from a fund's returns before the returns are paid to you. For example, the average U.S. stock fund has an operating expense ratio of 1.1% per year. So a U.S. stock index fund, or its peer exchange-traded fund, which is an index fund that trades on a stock exchange, with an expense ratio of just 0.1% per year, has an advantage of 1% per year. Another not-so-inconsequential advantage of index funds is that they can't underperform the market. Many actively managed funds do just that because of the burden of high fees and/or poor management. For money invested outside retirement accounts, index funds have an added advantage. Lower taxable capital gains distributions are made to shareholders because less trading of securities is conducted and a more stable portfolio is maintained. Yes, index funds may seem downright boring. When you invest in them, you give up the opportunity to brag to others about your shrewd investments that beat the market averages. On the other hand, with a low-cost index fund, you have no chance of doing worse than the market, which plenty of active investment managers do. Tip: index funds and exchange-traded funds make sense for a portion of your investments because beating the market is difficult for portfolio managers. The Vanguard Group, phone 800-662-7447, website vanguard.com, headquartered in Valley Forge, Pennsylvania, is the largest and lowest-cost provider of such funds. Specialty sector funds. Specialty funds don't fit neatly into the previous categories. These funds are often known as sector funds because they generally invest in securities in specific industries. Warning: in most cases, you should avoid investing in specialty funds. Investing in stocks of a single industry defeats one of the major purposes of investing in funds: diversification. Another good reason to avoid specialty funds is that they tend to carry higher expenses than other funds. Tip: specialty funds that invest in real estate or precious metals may make sense for a small portion, 10% or less, of your investment portfolio. These types of funds can help diversify your portfolio because they can do better during times of higher inflation. Selecting the best funds. When you go camping in the wilderness, you can do a number of things to maximize your chances for happiness and success. You can take maps, a smartphone, and a GPS to keep you on course, food for nourishment, proper clothing to stay dry and warm, and some first aid gear to treat minor injuries. But regardless of how much advanced preparation you do, you may have a problematic experience. You may take the wrong trail, trip on a rock and break your ankle, or lose your food to a tenacious bear that comes romping through camp one night. And so it is with funds. Although most fund investors are rewarded for their efforts, you get no guarantees. You can, however, follow some simple common-sense guidelines to help keep you on the trail and increase your odds of investment success and happiness. The factors in the following sections are the main ones to consider. Reading prospectuses and annual reports. Fund companies produce information that can help you make decisions about fund investments. Every fund is required to issue a prospectus. This legal document is reviewed and audited by the SEC. The most valuable information, the fund's investment objectives, costs, performance history, and primary risks, is summarized in the first few pages of the prospectus. Make sure that you read this part. Skip the rest, which is comprised mostly of tedious legal details. Funds also produce what's called a summary prospectus, which is an abbreviated version of the full-length statutory prospectus and which hits the important highlights. Funds also produce annual reports that discuss how the fund has been doing and provide details on the specific investments a fund holds. If, for example, you want to know which countries an international fund invests in, you can find this information in the fund's annual report. Keeping costs low. The charges you pay to buy or sell a fund, as well as the fund's ongoing operating expenses, can have a big impact on the rate of return you earn on your investments. Many novice investors pay too much attention to a fund's prior performance, in the case of stock funds, or to the fund's current yield, in the case of bond funds, and too little attention to fees. Doing so is dangerous because a fund can inflate its return or yield in numerous risky ways, and what worked yesterday may flop tomorrow. Fund costs are an important factor in the return you earn from a fund. Fees are deducted from your investment. All other things being equal, high fees and other charges depress your returns. What are a fund's fees, you ask? Good question. Read on to find the answers. Eliminating loads. Loads are upfront or ongoing annual commissions paid to brokers who sell mutual funds. Loads typically range from 3% to as high as 8.5% of your investment. Sales loads have two problems. Warning: Sales loads are an extra cost that drags down your investment returns. Because commissions are paid to the salesperson and not to the fund manager, the manager of a load fund doesn't work any harder and isn't any more qualified than a manager of a no-load fund. Common sense suggests and studies confirm that load funds perform worse on average than no loads when factoring in the load because the load charge is subtracted from your payment before your payment is invested. The power of self-interest can bias your broker's advice. Although this issue is rarely discussed, it's even more problematic than the issue of sales loads. Brokers who work for a commission are interested in selling you commission-based investment products. Therefore, their best interests often conflict with your best interests. Although you may be mired in high-interest debt or underfunding your retirement plan, salespeople almost never advise you to pay off your credit cards or put more money into your 401k. To get you to buy, they tend to exaggerate the potential benefits and obscure the risks and drawbacks of what they sell. They don't take the time to educate investors. I've seen too many people purchase investment products through brokers without understanding what they're buying, how much risk they're taking, and how these investments will affect their overall financial lives. Tip: invest in no-load, commission-free funds. The only way to be sure that a fund is truly no-load is to look at the prospectus for the fund. Only there, in black and white, and without marketing hype, must the truth be told about sales charges and other fund fees. When you want investing advice, hire a financial advisor on a fee-for-service basis, which should cost less and minimize potential conflicts of interest. Minimizing operating expenses. All funds charge ongoing fees. The fees pay for the operational costs of running the fund: employees' compensation, marketing, website development and maintenance, servicing the toll-free phone lines, creating, printing, and mailing published materials, technology for tracking investments and account balances, accounting fees, and so on. Despite being labeled expenses, the profit a fund company earns for running the fund is added to the tab as well. The fund's operating expenses are quoted as an annual percentage of your investment and are essentially invisible to you because they're deducted before you're paid any return. The expenses are charged on a daily basis, so you don't need to worry about trying to get out of a fund before these fees are deducted. You can find a fund's operating expenses in the fund's prospectus. Look in the expenses section and find a line that says something like total fund operating expenses. You can also call the fund's toll-free number and ask a representative. Remember, within a given sector of funds, for example money market, short-term bond, or international stock, funds with low annual operating fees can more easily produce higher total returns for you. Although expenses matter on all funds, some types of funds are more sensitive to high expenses than others. Expenses are critical on money market funds and very important on bond funds. Fund managers already have a hard time beating the averages in these markets. With higher expenses added on, beating the averages is nearly impossible. With stock funds, expenses are a less important but still significant factor in a fund's performance. Don't forget that over time, stocks average returns of about 9% per year. So if one stock fund charges 1% more in operating expenses than another fund, you're already giving up an extra 11% of your expected returns. Some people argue that investing in stock funds that charge high expenses may be justified if those funds generate higher rates of return. However, evidence doesn't show that these stock funds actually generate higher returns. In fact, funds with higher operating expenses tend to produce lower rates of return. This fact makes sense because operating expenses are deducted from the returns a fund generates. One additional cost not included in a fund's expense ratio is trading costs. The SEC requires funds to report these costs in their annual reports. Tip: stick with funds that maintain low total operating expenses and don't charge loads, commissions. Both types of fees come out of your pocket and reduce your rate of return. You have no reason to pay a lot for the best funds. Evaluating historic performance. A fund's performance or historic rate of return is another factor to weigh when selecting a fund. As all funds are supposed to tell you, past performance is no guarantee of future results. An analysis of historic fund performance proves that some of yesterday's stars turn into tomorrow's skid row bums. Many former high-return funds achieve the results by taking on high risk. Funds that assume higher risk should produce higher rates of return. But high-risk funds usually decline in price faster during major market declines. Thus, in order for a fund to be considered a best fund, it must consistently deliver a favorable rate of return, given the degree of risk it takes. Tip: when assessing an individual fund, compare its performance and volatility over an extended period of time, at least 5 to 10 years, to a relevant market index. For example, compare funds that focus on investing in large U.S. companies to the Standard & Poor's 500 index. Compare funds that invest in U.S. stocks of all sizes to the CRSP U.S. Total Stock Market Index. Indexes also exist for bonds, foreign stock markets, and almost any other type of security you can imagine. Assessing fund managers and fund family reputations. Much is made of who manages a specific mutual fund. As Peter Lynch, the retired and famous former manager of the Fidelity Magellan Fund, said, "The financial press made us Wall Street types into celebrities, a notoriety that was largely undeserved. Stock stars were treated as rock stars. Although the individual fund manager is important, no fund manager is an island. The resources and capabilities of the parent company are equally important. Different companies have different capabilities and levels of expertise in relation to the different types of funds. When you're considering a particular fund, for example the Barnum & Barney High-Flying Foreign Stock Fund, examine the performance history and fees not only of that fund, but also of similar foreign stock funds at the Barnum & Barney Company. If Barnum's other foreign stock funds have done poorly, or Barnum & Barney offers no other such funds because it's focused on its circus business, those are strikes against its high-flying fund. Also, be aware that star fund managers tend to be associated with higher expense funds to help pay their celebrity salaries, and star managers tend to leave or get hired away after several years of stellar performance, so you may not be getting the manager who created that good past performance in the first place. Index and asset class funds that use a team approach avoid this issue. Rating tax friendliness. Investors often overlook tax implications when selecting funds for non-retirement accounts. Numerous funds effectively reduce their shareholders' returns because of their tendency to produce more taxable distributions, that is, capital gains, especially short-term gains, which are taxed at the highest federal income tax rate, and dividends. See the dividends and capital gains sections later in this chapter. Fund capital gains distributions have an impact on an investor's after-tax rate of return. All fund managers buy and sell stocks over the course of a year. Whenever a fund manager sells securities, any gain or loss from those securities must be distributed to fund shareholders. Securities sold at a loss can offset securities sold at a profit. When a fund manager tends to cash in more winners than losers, investors in the fund receive taxable gains. So even though some funds can lay claim to producing higher total returns, after you factor in taxes, they actually may not produce higher total returns. Choosing funds that minimize capital gains distributions helps you defer taxes on your profits. By allowing your capital to continue compounding as it would in a retirement account, you receive a higher total return. When you're a long-term investor, you benefit most from choosing funds that minimize capital gains distributions. The more years that appreciation can compound without being taxed, the greater the value to you as the investor. Tip: if you're purchasing shares in funds outside tax-sheltered retirement accounts, consider the time of year when making your purchases. December is the most common month in which funds make capital gains distributions. When making your purchases late in the year, ask whether the fund may make a significant capital gains distribution. Consider delaying purchases in such funds until after the distribution date. Determining your needs and goals. Selecting the best funds for you requires an understanding of your investment goals and risk tolerance. What may be a good fund for your next-door neighbor may not necessarily be a good fund for you. You have a unique financial profile. Remember, if you've already determined your needs and goals, terrific! Understanding yourself is a good part of the battle. But don't shortchange yourself by not being educated about the investment you're considering. If you don't understand what you're investing in and how much risk you're taking, stay out of the game. Deciphering your fund's performance. As a fund investor, you can't simply calculate your return by comparing the share price of the fund today to the share price you originally paid. Why not? Because funds make distributions of dividends and capital gains, which, when reinvested, give you more shares of the fund. Even if you don't reinvest distributions, they create an accounting problem because they reduce the share price of a fund. Otherwise, you can make a profit from the distribution by buying into a fund just before a distribution is made. Therefore, over time, following just the share price of your fund doesn't tell you how much money you've made or lost. Tip: the only way to figure out exactly how much you've made or lost on your investment is to compare the total value of your holdings in the fund today with the total dollar amount you originally invested. If you invested chunks of money at various points in time, and you want to factor in the timing of your various investments, this exercise becomes complicated. The total return of a fund is the percentage change of your investment over a specified period. For example, a fund may tell you that in the past year, its total return was 15%. Therefore, if you invested $10,000 in the fund on the last day of the prior year, your investment will be worth $11,500 at the end of that year. To find out a fund's total return, you can visit the company's website, call the fund company's toll-free number, or read the fund's annual report. The following three components make up your total return on a fund. Dividends includes interest paid by money market or bond funds, capital gains distributions, share price changes. In short, you calculate a fund's total return as follows: dividends plus capital gains distributions plus share price changes equals total return. The following sections discuss each of these components in more detail. Dividends. Dividends are income paid by investments. Both bond funds and stocks can pay dividends. Bond fund dividends, the interest paid by the individual bonds in a fund, tend to be higher, as a percentage of the amount you have invested in a fund. When a dividend distribution is made, you can receive it as cash, which is good if you need money to live on, or reinvest it into more shares in the fund. In either case, the share price of the fund drops to offset the payout. So if you're hoping to strike it rich by buying into a bunch of funds just before their dividends are paid, don't bother. You'll just end up paying more in income taxes. If you hold your mutual fund outside a retirement account, the dividend distributions are taxable income, unless they come from a tax-free municipal bond fund. Dividends are taxable whether or not you reinvest them as additional shares in the fund. Stock dividends are taxed at a low rate, 0% for those in the federal 10 and 12% tax brackets, 15% for most people in the higher federal tax brackets, and 20% for those in the highest federal income tax brackets. From Obamacare, there is also a 3.8% surcharge on investment earnings for higher income taxpayers. Capital gains. When a fund manager sells a security in the fund, net gains realized from that sale, the difference from the purchase price, must be distributed to you as a capital gain. Typically, funds make one annual capital gains distribution in December, but distributions can be paid multiple times per year. As with a dividend distribution, you can receive your capital gains distribution as cash or as more shares in the fund. In either case, the share price of the fund drops to offset the distribution. For funds held outside retirement accounts, your capital gains distribution is taxable. As with dividends, capital gains are taxable whether or not you reinvest them in additional shares in the fund. Capital gains distributions can be partly comprised of short-term and long-term gains. As I discuss in Chapter 7, profits realized on securities sold after more than a one-year holding period are taxed at the lower long-term capital gains rate. Short-term gains are taxed at the ordinary income tax rate. Tip: if you want to avoid making an investment in a fund that is about to make a capital gains distribution, check with the fund to determine when capital gains are distributed. Capital gains distributions increase your current year tax liability for investments made outside of retirement accounts. Share price changes. You also make money with a fund when their share price increases. This occurrence is just like investing in a stock or piece of real estate. If the fund is worth more today than it was when you bought it, you've made a profit, on paper at least. In order to realize or lock in this profit, you need to sell your shares in the fund. Evaluating and selling your funds. Warning: how closely you follow your funds is up to you, depending on what makes you happy and comfortable. I don't recommend tracking the share prices of your funds, or other investments for that matter, on a daily basis. It's time-consuming and nerve-wracking, and it can make you lose sight of the long-term, big picture. When you track your investments too closely, you're more likely to panic when times get tough. And with investments held outside of retirement accounts, every time you sell an investment at a profit, you get hit with taxes. Tip: a monthly or quarterly review is more than frequent enough for following your funds. Many publications and websites carry total return numbers over varying periods, so you can determine the exact rate of return you're earning. Trying to time and trade the markets so you buy at lows and sell at highs rarely works. Yet an entire industry of investment newsletters, hotlines, online services, and the like purport to be able to tell you when to buy and sell. Don't waste your time and money on such predictive nonsense. Consider selling a fund only when it no longer meets the criteria mentioned in selecting the best funds earlier in this chapter. If a fund underperforms its peers for at least a 2-year period, or if a fund jacks up its management fees, it may be a good time to sell. But if you do your homework and buy good funds from good fund companies, you shouldn't have to do much trading. Tip: finding and investing in good funds isn't rocket science. Pick up a copy of the latest edition of my book, Mutual Funds for Dummies, Wiley, and visit my website at erictyson.com for more details on the best exchange-traded funds and mutual funds. 4. Small business tax reduction. In this part, understand how taxes work for small businesses. Choose a business entity that best reduces your taxes and liability. Claim deductions and applicable tax credits. Chapter 10. Small Business Taxes 101. In this chapter, appreciating the value of year-round tax planning, keeping tabs on corporate and individual tax reform, noting the various taxes you and your business pay. Though some of my other books deal with the drudgery of completing required tax forms, much of this one deals with the more interesting, and dare I say fun, part of taxes, which is planning ahead and strategizing so as to reduce and minimize your taxes. You see, if you simply view your role with taxes and your small business as jumping through the many hoops that federal, state, and local authorities require, you're missing out on something really big: saving and keeping more of your hard-earned money. This chapter introduces the basics of small business taxes. Here I discuss the value of tax planning all year long, and I define some important tax-related terms regarding the taxes you pay or may come across. Valuing year-round tax planning. Taxes are a large, vital piece of your small business and personal financial puzzle. You're required by law to complete your tax forms each year and pay the taxes you owe. You do this because you have deadlines and don't want contact initiated by local or state authorities or the IRS to result in fines, penalties, or worse, jail time. Nothing really forces you to plan ahead regarding your tax situation and small business. That's why the vast majority of small business owners don't take steps year-round to plan and reduce their taxes. However, tax planning all year is valuable because it enables you to stay on top of your tax and business financial situation and minimize the taxes you legally owe. In this section, I explain typical ways in which taxes enter small business decisions and some common tax mistakes folks make in this realm. Factoring taxes into small business decisions. Remember, taxes infiltrate many areas of your small business and your personal finances. Some people make important financial decisions without considering taxes and other important variables. Conversely, in an obsession to minimize or avoid taxes, other people make decisions that are counterproductive to achieving their long-term business and personal financial goals. Although taxes are an important component to factor into your major business and financial decisions, taxes shouldn't drive or dictate the decisions you make. The following list shows some of the ways that tax issues are involved in making sound financial decisions throughout the year. Type of business and benefits offered. The type of business entity you select for your business, sole proprietorship, S-corporation, limited liability company, LLC, and so on, can have significant tax and other consequences. The benefits you're able to utilize and offer to your employees, if you have them, also have tax ramifications. See Chapter 12. Retirement accounts. Taking advantage of retirement accounts can mean tens, perhaps even hundreds of thousands more dollars in your pocket come retirement time. Offering retirement account access to your employees can also be a valuable employee benefit for recruiting and retaining good employees if they understand what they have. Spending. The spending decisions you may face in your small business, such as buying equipment, spending on employee benefits, Chapter 12, and so on, will often affect your taxes both now and in the future. Protecting your assets. Some of your insurance decisions also affect the taxes you pay. You'd think that after a lifetime of tax payments, your heirs would be left alone when you pass on to the great beyond, but that's wishful thinking. Estate planning can reduce the taxes that are siphoned off from your estate. See Chapter 6 to find out more about estate planning. Tracking your business financials. Throughout the year, you should stay on top of your business's income and expenses so that you can see your business's financial health and record the numbers you need come tax time. Checking out common tax mistakes. Even if some parts of the tax system are hopelessly and unreasonably complicated, there's no reason why you can't learn from the mistakes of others to save yourself some money, no matter the time of year. With this goal in mind, this section details common tax blunders that people make when it comes to managing their money. Seeking advice after an important decision. Too many people seek out information and hire help after making a decision, even though seeking preventative help ahead of time generally is wiser and more financially beneficial. Tip: before making major small business and financial decisions, educate yourself. This book can help answer many of your questions. You may also want to do further research on your own and/or hire a tax advisor for some advice before making your decisions. For more in-depth information about small business taxes, check out the most recent edition of my book, Small Business Taxes for Dummies, Wiley. Failing to withhold or submit enough taxes. If you're self-employed or in significant taxable income from investments outside retirement accounts, you need to make estimated quarterly tax payments. You also need to withhold taxes for your employees and send those taxes along to the appropriate tax agencies. Some small business owners don't have a human resources department to withhold taxes and dig themselves into a perpetual tax hole by failing to submit estimated quarterly tax payments. To make quarterly tax payments, complete IRS Form 1040-ES, Estimated Tax for Individuals. This form and its accompanying instructions and payment coupons explain how to calculate quarterly tax payments. For more information on the requirement for employee tax withholding, please see Small Business Taxes for Dummies, Wiley. Missing legal deductions. Remember, some taxpayers miss out on legitimate tax write-offs because they just don't know about them. If you aren't going to take the time to discover the legal deductions that are available to you and that I discuss throughout this book, then you should pay for the cost of a competent tax advisor at least once. Fearing an audit, some taxpayers, and even some tax preparers, avoid taking deductions that they have every right to take. Unless you have something to hide, such behavior is foolish and costly. Note that a certain number of returns are randomly audited every year, so even when you don't take every allowable deduction, you may nevertheless get audited. Forsaking retirement accounts. All the tax deductions and tax deferrals that come with accounts such as 401ks, SEP IRA plans, and individual retirement accounts, IRAs, were put in the tax code to encourage you to save for retirement. That's something that you as a small business owner should be doing for yourself, as well as encouraging your employees to do. Most excuses for missing out on these accounts just don't make good financial sense. Some folks underfund retirement accounts because they spend too much and because retirement seems so far away. Others mistakenly believe that retirement account money is totally inaccessible until they're old enough to qualify for senior discounts. Not owning real estate. In the long run, owning a home should cost you less than renting. And because mortgage interest on up to $750,000 of mortgage debt and property taxes up to $10,000 when combined with your state income tax payments are deductible, the government in effect subsidizes the cost of home ownership. If you have a home office, you may be able to take additional expenses on your tax return. If you need a retail or commercial space for your small business, you should compare leasing to buying and be sure to factor in the tax benefits of owning. Neglecting the timing of events you can control. Tip: as a small business owner, you should pay attention to how your net income for the year is shaping up for the current year and how things are looking for next year. For example, if you're in the early stages of your business and you can see that you'll have more income next year, then it may be in your best interest, tax-wise, to delay paying some expenses from late in the current year into early next year. This works when using cash basis accounting. Or suppose that you operate on a cash accounting basis and think that you'll be in a lower tax bracket next year. Perhaps business has slowed of late, or you plan to take time off to be with a newborn or take an extended trip. You can send out some invoices later in the year so that your customers won't pay you until January, which falls in the next tax year. Not using tax advisors effectively. Remember, if your financial situation is complicated, going it alone and relying only on the IRS publications to figure your taxes usually is a mistake. Many people find the IRS instructions tedious and not geared toward highlighting opportunities for tax reductions. Instead, you can start by reading the relevant sections of this book. When you're overwhelmed by the complexity of particular small business and tax decisions, get advice from tax and financial advisors who sell their time and nothing else. As a small business owner, ask yourself how much you're worth running your business versus how much you're worth as a bookkeeper. Then ask yourself which task you enjoy more and consider hiring a bookkeeper. Note that using a tax advisor is most beneficial when you face new tax questions or problems. If your tax situation remains complicated, or if you know that you do a worse job on your own, by all means, keep using a tax preparer. If your situation is unchanging, or isn't that complicated, consider hiring and paying someone to figure out your taxes one time. After that, go ahead and try completing your own tax returns. Noting how corporate and individual tax reform impacts small business. Corporate tax reform in the United States was long overdue. For too many years, corporations in the United States faced a much higher corporate income tax rate than did companies based in most overseas economies. As a result, increasing numbers of U.S. companies had chosen to expand more overseas rather than in the United States, and to be headquartered outside of the United States, which wasn't good for the long-term health of the U.S. economy and labor market. Congress passed the Tax Cuts and Jobs Act in late 2017, which took effect with tax year 2018. It was the most significant tax reform package passed since the Tax Reform Act of 1986. What follows are the highlights of the most significant provisions that affect and mostly benefit small business. Chapter 1 also covers these reforms. Checking out corporate income tax rate reduction and simplification. At 35%, the United States had had one of the highest corporate income tax rates in the world before 2018. The Tax Cuts and Jobs Act slashed the corporate income tax rate to 21%, which represented a 40% reduction. The corporate tax rules and deductions were simplified, including eliminating the corporate alternative minimum tax and closing some loopholes. The United States also moved to a territorial tax structure whereby U.S. companies would no longer pay a penalty to bring their overseas profits back home. The immediate impact of this change was to enable U.S. corporations to bring back to the United States more than $2 trillion being kept overseas to avoid excessive taxation. The vast majority of small businesses aren't operated as traditional so-called C Corps. More on those in a moment. Most small business owners operate as sole proprietorships, filing Schedule C, LLCs, partnerships, or S corporations. In those cases, the business owner's profits from the business generally flow or pass through to the owner's personal income tax return, and that income is taxed at personal income tax rates. See the section Noting 20% Deduction for Pass-Through Entities for more information. Reducing individual income tax rates. Just as the corporate income tax rate was reduced by the Tax Cuts and Jobs Act legislation, so too were the individual income tax rates. Most of the tax bracket rates were reduced by several percentage points. See Chapter 1. This, of course, is excellent news for the vast majority of U.S. small business owners who operate their businesses as pass-through entities. For example, sole proprietorships, LLCs, partnerships, S Corps. Note that at higher levels of income, the individual income tax rates begin to exceed the 21% corporate tax rate. Seeing this helps you to better understand the next point as to why pass-through entities are being granted a special tax deduction on their profits. Noting 20% deduction for pass-through entities. In redesigning the tax code, Congress rightfully realized that the many small businesses that operate as so-called pass-through entities would be subjected to higher federal income tax rates compared with a new 21% corporate income tax rate. Pass-through entities are small business entities such as sole proprietorships, LLCs, partnerships, and S corporations, and are so named because the profits of the business pass through to the owners and their personal income tax returns. To address the concern that individual business owners that operated their business as a pass-through entity could end up paying a higher tax rate than the 21% rate levied on C corporations, Congress provided a 20% deduction for those businesses. Another way to look at this is that the business would only pay taxes on 80% of its profits and would be in the 22% federal income tax bracket. This deduction effectively reduces the 22% tax bracket to 17.6%. This is a major change that, not surprisingly, has made small business owners exceedingly optimistic about being able to grow their businesses. In fact, in a 2018 survey of small business owners conducted by the nonprofit National Federation of Independent Business, just after the tax bill was passed and signed into law, a record percentage of those surveyed, covering the survey's 45-year history, expressed optimism about it being a good time to expand their businesses. This 20% pass-through deduction gets phased out for service business owners, such as lawyers, doctors, real estate agents, consultants, and so on, at single taxpayer incomes above $191,950 up to $241,950, And for married couples filing jointly, incomes more than $383,900 up to $483,900. For other types of businesses above these income thresholds, this deduction may be limited, so consult with your tax advisor. Enjoying better equipment expensing rules. Through so-called Section 179 rules, small businesses have historically been able to immediately deduct the cost of equipment subject to annual limits they purchase for use and place into service in their business. But the 2017 tax bill expanded these rules. Now more businesses can immediately deduct up to $1 million in such equipment expense annually, up to the limit of their annual business income. And this deduction can also now be used for purchases on used equipment. These provisions, which don't apply to real estate businesses, remained in effect through 2022, but then gradually phase out by 2027, when the prior depreciation schedules are supposed to kick back in. Increasing maximum depreciation deduction for automobiles. The new tax bill included a major increase in the maximum amount of auto depreciation that can be claimed. The annual amounts of auto depreciation have more than tripled. The annual limits will increase with inflation for cars placed into service in future years. Limiting interest deductions. Effective with 2018, companies with annual gross receipts of at least $25 million on average over the prior 3 years are limited in their deduction of interest from business debt. Net interest costs are capped at 30% of the business's earnings before interest, taxes, depreciation, and amortization, EBITDA. Farmers and most real estate companies are exempt. Since 2022, this provision got more restrictive and thus impacts more businesses. Now the 30% limit applies to earnings before interest and taxes. Reducing meal and entertainment deductions. The Tax Reform Bill of 2017 eliminated the entertainment expense deduction for businesses. Under prior tax law, 50% of those expenses were deductible. For example, when a business entertained customers and even employees at sporting events, fitness clubs, and restaurants. The new rules do include some exceptions. On-site cafeterias at a company's offices and meals provided to employees, as well as business meals associated with travel, are 50% deductible. Meals provided to prospective customers as part of a seminar presentation are still fully deductible. Holiday parties and company picnics are also fully deductible as long as they are inclusive of everyone. Eliminating the health insurance mandate. Since the Affordable Care Act, aka Obamacare, was passed by Congress in 2010, some Republicans in Congress vowed to repeal it. With the election of Republican Donald Trump in 2016, it seemed that the pieces were in place for Obamacare's successful repeal. But Republicans fell one vote short in the Senate when the late Arizona Senator John McCain gave the repeal measure his infamous thumb-down vote. So the 2017 tax bill included a little-known or discussed measure that eliminated Obamacare's mandate effective in 2019, which required people to have or buy health insurance coverage, and if they didn't, they'd face a tax penalty. So the penalty tax also disappeared in 2019. Revising rules for using net operating losses. Net operating losses, NOLs, can no longer be carried back for 2 years. However, NOLs may now be carried forward indefinitely until they are used up. Previously, the carry-forward limit was 20 years. NOLs are limited each year to 80% of taxable income. Understanding how businesses are taxed. As I explained earlier in this chapter, the vast majority of small business owners pay income taxes on their business earnings at the personal income tax rates described in Chapter 1. That's because most small businesses are organized as sole proprietorships, which have income taxed as personal income. Also, many other small businesses that are organized as partnerships, LLCs, and S-corporations pass through their income to the business owners in such a way that it, too, is taxed as personal income. Thus, only a small percentage of small business owners have their income taxed as regular so-called C corporations. The Tax Cuts and Jobs Act, which took effect in 2018, compressed the previous numerous corporate income tax brackets to just one rate, 21%. In the next chapter, I discuss how the tax rate a business pays, along with other factors, plays a role in determining what's the best business entity for your business. For more detailed information about how total taxes, taxable income, marginal tax rates, and corporate tax rates affect business owners, please see the most recent edition of my book, Small Business Taxes for Dummies. Wiley.